Hedge funds in South Africa bet on new rules to stem outflows. African Development Bank signs $600 million facility agreement with Ghana Cocoa Board. And Zimbabwe bans new electric water heaters to save energy. Hello and welcome, and thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwagu. We get the show started now with the markets, and here on the African continent, we saw mixed sentiments trailing the markets at intraday. While the market here in Nigeria saw massive gains as at midday Nigerian time, up 1.50%. The Jersey index in South Africa slipped 0.24%. The Egyptian stock still sustained their downward trend as it was down 0.56%. However, the Nairobi Stock Exchange closed positive on Wednesday's trading session. And in the Gulf region, it was all green at intraday. Dubai financial markets led the pack, up 1.92%. The Abu Dhabi index rose 1.34% higher after 6 straight sessions of losses. The Qatari index edged higher by 0.84%, while the Saudi Arabian stocks index also climbed by 0.63% at intraday. And in Europe, stocks traded slightly lower in the morning as trade negotiations between the U.S. and China are understood to have hit a roadblock. German GDP, of course, grew by 0.1% in the third quarter, exceeding the 0.1% contraction expected and narrowly avoiding a technical recession. Well, that's where I will start my conversations with Chelsea. Hello, Chelsea. Good afternoon. Well, a good one coming from Germany. Data released today showed that your country has narrowly escaped falling into recession in the third quarter. Has the outlook brightened for Europe's largest economy?
I think it's probably too early to read too much into this data today. So 0.1% growth it's growth, but it's very, very marginal growth. And the signals that we've gotten out of Germany recently have been very mixed, and this report as well was quite mixed. So some of the bright spots were strong domestic consumption. Consumers still are spending. The services sector is still doing quite well, but this did show a slowdown in machinery and equipment investing, and the second quarter GDP growth was actually revised down lower. So it's definitely a mixed report. There have been several data reports over the past couple of weeks that have been quite good. So things like exports and a lot of sentiment data, so how businesses and consumers are thinking about the economic outlook going forward has seemed to bottom out. So there definitely is hope that the German economy has at least stopped declining, but I think it's also important to consider that even if the growth has sort of stabilized, we're still talking about stagnation. We're still talking about growth at best around 1% next year. So it's not really the beginning of a long-term broad-based upswing for Germany. The growth is still going to be quite constrained for the near future.
In the meantime, we have seen economic data out of Japan and China raising concerns about weakening growth in both economies. What are investors making out of these reports?
Well, I think in contrast to the German data that we saw today, there's really not much to be optimistic about from either the Japanese or the Chinese growth figures. In China, they reported declines across basically every part of the economy. Industrial production, of course, which is being hit by trade negotiations with the U.S., but also declines in retail sales and the construction industry. So it's really a broad-based slowdown there. And they're also dealing with rising inflation. So inflation is at the highest level in China in 8 years. So that's going to make it really difficult for policymakers to introduce more stimulus into the economy without raising inflation any further. And in Japan, they're also not expecting any sort of upswing anytime soon because they are struggling with a new sales tax that is expected to reduce consumption going forward. So it's really hard to imagine any sort of upswing in either of these economies going forward, and that's going to have a large impact on the markets there. And we saw Japanese stocks down about 1% today. Chinese stocks were mixed, but the outlook is quite grim.
Well, in corporate news, German automaker Daimler says it is seeking about 1 billion euros in personnel cut over the next few years. Of course, they're going through tougher emission standards, hitting their earnings. How is the stock reacting?
This is a bit of a shock to the market. The stock fell about 5% earlier in Frankfurt trading, but it's recovered a bit and it's down about 3%. I think investors have been anticipating these cost cuts. They've been anticipating a restructuring at Daimler. The company has been talking about the need to do this all year, but I think they weren't quite expecting the outlook from the company to be so bleak, and the comments from the company's executives to be so grim. They've talked about how these investments in electric vehicles are going to be eating into profit for the next couple of years. They're going to stop. They're going to cap investment in research and development for the next couple of years, as well as in addition to cutting likely over 1,000 jobs at Mercedes-Benz. So I think this is a bit of a surprise just how costly and how difficult this transition to electric vehicles is going to be for Daimler.
All right, Chelsea, thank you for updating us on those developments. Enjoy the rest of the day.